it starts with your tenant profile. So, one of the things that we encourage people to consider is factors such as age, lifestyle, occupation, and interests when identifying potential renters. So, as an example, do you prefer to maybe rent to seniors? Do you prefer to rent to families? Do you want to rent to students for certain reasons? Do you want to rent to people on a short-term rental, like hospitality basis, etc.? It's totally fine to be completely agnostic and just like not care which one, but then at least And if you haven't thought about these things, like some people actually do think, oh, I don't want to rent to students. Okay, cool. Well, we know we're not buying a student rental property then. Or, oh, I don't want to deal with hospitality and constant turnovers of guests. Okay, cool. Well, we know we're not buying an Airbnb. Or you just say, I don't care. Okay, now we've broadened our market and we're going to have to find a niche in some other category, right? But by carefully selecting a tenant group that aligns with your goals as a landlord, should you want to kind of narrow down on this niche component, you can ensure a better relationship with your tenant or tenants.
Yeah, I love that, Dan. And we've said this time and time again, and I will say it again on the podcast. Tenants are the real asset. Tenants are our clients as landlords and property owners and investors,
Yeah,
right?
I will I'll add to that a little bit more because we had that conversation with Chip Wilson, and he talked about how this is like the original subscription model business, right? Everybody
Yeah.
wants MRR, monthly recurring revenue. It's like, okay, well, you're even if you're renting to a business, the business still has principals and somebody that you have to engage with in regards to managing that lease. And so at the end of the day, we have this customer service role basically where we have to provide somebody. And so think about who your customer is. In any business, one of the first things that you want to do is identify the customer that you're serving. This is no different, honestly, really not different. So
100%. And look, this is again something that we talk a lot about on the podcast, teach in the course, something that you and I implement in our own strategies, which is reverse engineering, right? A lot of great investors I know, they have that tenant profile picked out first, and then they go and either buy or build or renovate in order to attract that specific tenant. Now, moving on to the next piece here, geography, right? Essentially location, location, location to a certain extent. Some questions to ask yourself here are: what type of amenities do you want or need your future rental property to be near? Right? Think about things like school districts, public transit, types of healthcare, old age homes, highways, and again, major ulterior roads. Consider the current market and the affordability in that specific region. And there could be different affordabilities within different cities. There could be different affordability within different provinces. So this is where you got to get really, really specific. And also, if you've got current resources there to help you fulfill your duties as a landlord. So first one, tenant profile. Second one to consider is geography. Dan, what is the third consideration when trying to come up with your first investment thesis?
yeah, the next piece I would look at is the asset class you want to invest in. Are you looking for a single family home, a duplex, a triplex, multifamily? Are you looking for something commercial, land, industrial? Are you looking for long-term or short-term rental? Are you looking for a long-term or short-term hold for your asset? You got to think about these things in your acquisition criteria.
100%. And we're not done with assets just yet, because outside of asset class, we also need to think about asset quality. Now, within every single one of those asset classes that Dan just mentioned, there are different categories of quality within those. Are we looking for something turnkey, right? That literally you essentially turn the key, you open it up, and you are good to go? Or are we looking for something that provides a little bit more work, something that you can add value to? And then you got to ask yourself the question: how much work am I willing to put into the property? What is my plan for value out of this property? How much more capital do I need if I'm going that add value strategy? And what kind of strategies kind of implement to make that happen?
Yeah, absolutely. And I think I would add to that to kind of segue to what I'm going to mention next is, are you expecting to a premium if it's going to be a premium product, or are you expecting a discount? Like, where are you shopping? Because a lot of people want the best price, but then they also want the best asset at the same time. So
That's what everyone
is it
wants.
realistic? Yeah. Is it realistic? Um, and kind of segueing from that to what is your expected return, right? What are you expecting to get out of this financially? How do you quantify your expectation? This is like the biggest thing that I think, had people actually done this math and set their expectation, like you hear a lot about like in the guru space, or like, whatever, yoga, meditation, etc. And I'm like, I'm into that stuff, so I'm not saying this facetiously, but you hear a lot about the word intention, right? Set your intention for the day. do like did you guys set an intention for your investment when you were going levered long on a HELOC into pre-construction condos? Because if you did, you might not have ended up in that bad position. And if you did, maybe you're one of the few people who got out unscathed. And so this is like where people need to think about and run the spreadsheet, do the math, like just do the math. What kind of return are you hoping for? Is it actually achievable? Is it a high return, like burr strategy as an example, which is very tough and done at the margins? Are you just trying to do it, reasonable add value, and you just want to get that asset as soon as you can because you want to capitalize on the amortization schedule and get that mortgage paid down? And each time that mortgage term renews, the mortgage pays itself down faster. Are you looking to have more of a job, let's call it, right? A lucrative job with an Airbnb. You want to be more involved, but you're getting that higher return expectation so you can do the hospitality element. Um, that could require a bit more work, just like a burr or an add value. Then you could maybe do a trade-off where you're looking for a lower return category, like maybe a core rental in the city of Toronto, or even a luxury rental. Or you could try and be a slumlord or a terrible landlord. Not financial advice, but a lot of people approach it that way, which also requires very low work, right? So how do you think about the return expectation, and similarly, not just return on your capital, but return on the work and the energy and time and focus that you're going to put into the asset?
Yeah, couldn't agree more. And the next piece here, this is kind of where you got to ask yourself some tough questions and be really brutally honest with yourself as well. Is what is your risk profile? The same way that you'd fill out whatever, if you're on Wealthsimple or whatever kind of stock investing you might do, and there's always that question: what's your risk profile? Right? Do you want to take a chance and ride the market, ride the waves of the market, and potentially risk losing a ton of money, or potentially have a ton of money to play with? This is going to depend on certain things, like what's your age, how soon do you want to achieve your goals, right? Like we look at younger people, and older people look at younger people, and they're thinking, okay, well, this person has a lot of time to make up for those potential mistakes, right? If you go and screw your first investment up in your early or mid 20s, that's probably a little bit more achievable to come back from than if you are in your mid to late 60s. You need to be a little bit more careful, right? So you got
Then
to
you just
think
do the
about,
Tiger King thing where you say you're never going to financially recover from this.
yeah. So then you got to really figure out, uh, how soon you want to achieve those goals, right? And that all comes down to the business plan that you're doing, what kind of return expectations, the stuff that you were just talking about, Dan, right? And then again, kind of liquidity, what type of liquidity preferences do you have? When do you want to have that potential big money moment that you can pull out from? So let's just do a quick summary of this again for you guys. So again, tenant profile: age, income, interests.
Then we have geography, population, age, and population growth rate, house prices, affordable versus expensive, density, amenities, what's the ideal municipality, what's the ideal province, etc.
Asset class and asset quality: single family, duplex, triplex, commercial, industrial, retail. Is it turnkey? Is it a fixer upper? Is it add some value? Is it totally gut and renovate?
And what type of investor do you want to be? Do you want to be passive? Do you want to be capital only? Do you want to, capital only would be REIT, private lending, limited partner, semi-passive, like an income property, or more active burr, flip, Airbnb, etc.
And then finally, asking yourself those tough questions: what is your risk profile? Are you low risk? Because that is going to pigeonhole you into certain strategies. Are you medium risk, which kind of allows you to play in a much larger sandbox? Or are you high risk and just going full send into real estate investing? These are questions that you are going to have to ask yourself.
And when you go through this exercise, get into as much detail as possible so that when you actually get to the acquisition phase, a lot of the due diligence or pre-diligence that you have to do is already done. And all you're really doing is saying, does this deal fit into the parameters that I've already set out? And if you look at the best funds, they all have acquisition parameters. You know, even like the biggest groups, Blackstone and all, you know, like they'll have different fund parameters, different funds that they've raised for, and they've said, hey, investors, we're going to take your capital, and this is the box that we're going to put it in. We will only put your capital in that box. And so investors know, okay, if I believe in that the idea behind that box, then I am comfortable putting my money in this fund. You need to treat your own capital the same way. If you want to be the best in the world at this, which you should, honestly, like, I don't know, there's like what is it? YOLO? Is that what they say? YOLO. You only live once. You might as well do a good job at it. Honestly, that's my perspective, right? So that, get, be thorough and exhaustive and like take care in doing that. I'm really quoting Drake so much here. YOLO, take care. But
I love it. Is it is it
you know,
is it by any chance because one of Drake's good friends just followed you on Instagram? So I had to throw
maybe,
that
yeah,
in there.
yeah.
Dana and I
No,
are
yeah,
both
that
we're
could be why.
resting on our lows. Justin Bieber's mom just recently followed us. Drake's buddies are following us now. It's kind of cool.
Yeah,
Anyways,
I guess.
you're
Yeah, I don't
quoting
know.
Drake to pay tribute
I don't even
to.
know, man. Like, you know, because who knows if the all that beef. I thought Kendrick Lamar was going to crash the Canadian real estate market with that. So
But no, Dan. I mean, to get back on track, you're totally right. Like, why don't we look at what the biggest and best funds in the world are doing and take those same practices, right? And on that note, it might take you a few weeks or hell, even months of working on what you think your investment thesis is or what you maybe want it to be, only to discover that that actually won't work for you, it won't serve you or help you achieve your goals. But look, that is okay. You go back to the drawing board. And when you're going back to that proverbial drawing board, you're going back with a clearer head, more information, more data than you had before. Hence, the next round, you'll be able to make better decisions.
yeah, it is interesting because you'll often see people where they have a good thesis, and it's like, we've come to an agreement that this is going to really help them get to their or achieve their goals, and then they can't find a deal that fits it. And what the mistake I see a lot of people making is they try and change the thesis to fit the deal. They don't
Yeah,
try and change
such
the
a
deal to fit the thesis,
good call.
right?
Yeah.
So you'll see a lot of people where it's like, hey, I only was going to buy at a 6.5 cap, but this deal's like it's a 6.1 or whatever. I'm going to make an exception here because I think I can stabilize it a little higher. It's like, well, no, your rules are your rules. You're only as good as your ability to honor them. Drop the price, offer low, right? Or get it vacant so you can stabilize immediately with the rents or whatever. Don't make exceptions. Like, the point of doing all of this is so that you don't have to make exceptions, because you've said, okay, this is my model. As long as I follow these rules, I will achieve my goals. Then 10 years from now, when you see the compounding of of following your own rules, you'll be grateful. Similarly, if you 10 years from now is when you'll actually feel the compounding of not following your rules, because
Yeah.
that slight difference in your yield compounded out over 10 years is massive difference. And like, I think that when you hear personal finance gurus talk about it almost seems like a little bit wild when they're like, oh, if you didn't save, your savings rate went from like 11% to 10.5%. It's like, well, stretch that out over 20 years, which is the lifetime of the asset class that we're investing in, and it makes a big difference. So
Yeah,
anyway,
100%. Well, to be honest, exactly what you just said, Dan, that goes back to that first principle of why your why is so important, right? Like, you cannot deviate from the rules that you set for yourself. And yeah, like it's trust me, hey, you and I have been there. We've worked on stuff for like one of the first deals we ever worked on. We worked on for like a year and a half and it went absolutely nowhere. We made no money off of it. We spent a ton of time on it, but we didn't deviate from what we knew was the right thing to do with that deal. We knew why we were doing it, and we could have maybe deviated and tried to get it done and but we would have been, we would have screwed ourselves and our client at the end of the day. So when you outline those principles for yourself, you desperately need to stick to them. Otherwise, it's the slippery slope. So again, going back to that why
Mm-hmm.
and being able to push through those hard times, crucial.
Yeah, I think it also gives you the ability to be outcome independent. Like if you say I'm only going to buy this deal at a 6.25 cap, and you enter your 6.5 cap, sorry, I'll use the original example, and you go into the seller and say that, like, look, that's all I'm willing to pay for your property, and then like a lot of people will say to you, the most powerful thing that you can do in negotiation is to walk away, right? And to be willing to walk away. And so as long as like at that point you can do that, and then that gives you a lot of like that outcome independence is what gives you the ability to be the stronger negotiator in a lot of cases. So
Mm-hmm.
anyway, um, now that you've put in that work and you're clear on your why and you're clear on your thesis, you have to start like any business. Like what we just gave you was the foundation of a business, and what the next phase of building a successful business is human capital. You got to start building a team.